Morning. It's Tuesday, the 27th of January, 2015. Um, we have a bit of a, I don't know if we can call it a failed blizzard back east, but it was as we expected. It was the comet Kahutek of mothers of all blizzards. Didn't quite live up to its billing, although I'm sure there's a lot of shoveling going on along the eastern seaboard. Uh, Near record highs here in Colorado, by the way. Skiing's great, but the temperatures for the last couple of days have been in the upper 60s. Um, Great place to vacation right now if you want to get away from the snow or have snow within a 90-minute drive to ski on. Looking at a chart of gold here, I did mention that there was good news and bad news with respect to the rally. The good news is that we are bullishly impulsive on the hourly chart in February gold. And, well, I see that this god-awful Citrix problem, I'm trying to get the price bars display open, high, low, close, but I've had a problem that the best and the brightest at Citrix have been unable to resolve. So let me get out a data window. We'll have to use this clunky thing right here. All right, so we've got an impulsive rally in gold, but not, and that's a good thing, and we'll give bulls the benefit of the doubt. Any pullback that we might have from today's high, which occurred at 1297.40, is ostensibly a buy. So it's a bull trade from here, but there are some doubts. You can see that the rally did stop just shy of taking out yesterday's what would be an external peak right there, and the idea being that any rally that is genuinely energetic, a rally just bristling with power, would easily have gotten past yesterday's little peak right there, and it didn't. So that's a suspicious sign. And another is that we do know that nothing feeds gold rallies so much as diving broad averages. So when the stock market is in a decline, we generally see, I don't know whether it's alternative money or money going into the alternative of gold, but we're not seeing too much of that today. The market is getting hit particularly savagely today, and yet all gold can muster is up 10 or 15 points. So that's a little bit disappointing, and we'll just have to play it by ear. Before we leave this chart, or before we leave gold, let's see if there's a way in. And well, let's see. It's not a great time of the day to be getting long in gold, because typically we do not have explosive follow-through rallies to end the regular session. But the pattern that I would use to make entry would be right here, A, B, and I'm not going to use this C right here. That just begs to be tested, and I would wait for a lower point C, maybe take the second signaled entry price there on his pattern. Other than that, I don't see much in the way of trading opportunities at the moment. It's going to take just a little bit for the opportunity that I just mentioned to develop, but we're a little premature here in in speculating what might occur. So anyway, we've got some good encouraging rallies on these charts of lesser degree, but again, just to show you this 60-minute chart, a little bit disappointing on the hourly, because today's high has yet to get past this yesterday's peak. That could certainly be remedied by day's end. We still have a few hours for something to happen in gold, and it would be a welcome sign if we could get a little more of a follow through that gets past not only that external peak right there, but with just a little bit more effort, it could get past that one as well, and that would generate a very robustly bullish indication on the hourly chart. All right, I'm going to look at. I'm open to any questions that you might have. This session can be driven by your questions. Justin asks, what are sound energy trading strategies that will present opportunities? We don't go too much further afield than just trading the let's see if I can get this thing to, than trading the NYMEX crude oil futures, Justin. And there's been plenty of movement. Let me see if I can get this thing out of the way. And right now, signs are not too good. The clearest pattern I can find on the hourly chart for March 2015 NYMEX crude is this pattern right here. And you can see that the red line, it's a midpoint hidden pivot of this downtrending pattern, was support, and it was very precise support at one time. And to the extent that we've got these bounces from exactly 46.38 or very close to it, the integrity of the pattern is confirmed. And you can see now that that the red line, the midpoint pivot, has been transformed into a resistance that's just as clear. So it's over the last week or so, it's become it transformed from a support to resistance. But the interesting thing is that the hits on that red line are so precise that it absolutely validates the pattern. And what we can predict, because we've had a decisive move down through the red line, is that oil is going significantly lower. And not only significantly lower, but it's going precisely to 4102, which means that you could do some bottom fishing there with the stop loss, I'm guessing, as tight as 7 to 9 cents. It's a very promising looking hidden pivot support down there at 4102. And of course, you could be much more aggressive about bottom fishing there if you catch the short from 46.38 to 41.02. We have a couple ways of doing that. There's a mechanical trade that simply uses a 1 to 3 risk-reward relationship. It's obviously risky. I put out a mechanical idea in the E-mini S&Ps last night, trying to bottom fish something with the 7-point stop loss. Typically, we do not use anything even remotely like that. We'll use a stop loss of 3 to 5 ticks rather than the implied 28 ticks of a 7-point stop loss. All right, so it looks to me like this thing is going very precisely down to 4102, and I'm not going to get into the mechanical entry here in any detail, since it is one of the proprietary things that I teach in the webinar. Upcoming webinar, by the way, is I believe it's February 17th, but if you go to the home page, let me find it for you here. If you go to the Rick's Picks page, the webinar is the 17th, and you just click on seminar information page and it'll tell you what you need to know. Once you're registered for the course, you can take the entire course in recorded form ahead of the actual live webinar in mid-February, and you also have access to the Wednesday tutorial sessions where we get on charts in real time and try to figure out things to do. All right, so here, as far as other opportunities in energy, one of the reasons we trade futures and do so more or less mechanically, to technically trade it, is because it's pretty hard to figure out the energy picture and extrapolate whatever implications lower and lower oil prices hold for energy producers. and at some level even for the currency of sovereign entities that produce oil. A couple currencies are obviously pretty well hooked to energy resources, the Canadian dollar for one and the Aussie dollar for two. So we just try to keep it simple, trade the futures, and these futures are telling us that crude is heading very significantly lower, about 10 or 11% here. This is notwithstanding the fact that OPEC's General Secretary declared a bottom the other day. He said this is it. It's about as low as it's going to go. Technically, he's not on such solid ground, although we would put more store in what an OPEC minister or administrator has to say over what somebody from the Fed might say, because the Fed governors are all about lying, cheating, stealing to quote-unquote manage our expectations, but that's not quite as big a factor with OPEC. You're more likely to hear the truth from OPEC than you are from the lying, cheating, double-dealing, talk out the side of their mouths Fed governors, and most particularly the Fed chairman. All right, so that's about it for crude. Let's take a look at the E-mini S&Ps. Actually, we'll look at the diamonds, since I did put out some targets there, and it's not possible to trade the industrial average directly, but we can do some stuff in the diamonds. And let's see, maybe we can come down to the 15-minute chart and get a picture that works. I don't think it's over. We've got a clear downtrending ABC here that would take us at least to this red line, the midpoint pivot at 172.36. The actual so far low has been 172.59, so we've got 23 hundredths of a point to go to get there. And you can see also the implication is that if we break the red line, we're going all the way to the D hidden pivot target associated with that midpoint pivot at the red line. So that would be quite a fall. The implication is another, holy smokes, over 200 more Dow points. So we'd be down close to 600 points here, or 700 points if in the unlikely event that this thing falls to the max target today. But ordinarily, we would assume that a rally from some low that doesn't quite reach the midpoint pivot is bullish, but it only officially becomes bullish when that rally starts getting past prior peaks, the most immediate of which is right here at 173.96. So take a 100 point plus rally just to get this thing out of trouble, but it looks to me like it's going to go lower before it goes before this thing can get traction. And one of the ways we play these moves, these reversals, is by way of legging into call spreads. And if we're in a long-term play, we can try to leg into a vertical bull call spread with maybe 3, 4, 5 points in the spread. In other words, you can get as much as a riskless play on a $500 profit. But we can also do these things, leg into option spreads in a smaller way, just based on little moves that we see intraday. In other words, let me show you on a chart. Let's assume this thing comes down to 172 and 36/100ths, the target there. And what we would want to do, as soon as I can get this thing open here, all right, so we're going to put the diamonds up here, and we don't have to go too far out in time. Keep in mind that the types of trades we're doing, we expect our options position to go into the black to be profitable within 30 to 90 seconds. In other words, you shouldn't even be buying options if you don't think your position is going to be profitable within a minute or two of when you buy it. That's as much as saying that you want to buy puts at swing highs and calls at swing lows. So instead of going out months and months and months, we want to go out ahead days or maybe even hours in the case of our Friday jackpot trades. All right, so if we're looking at the January Friday expiration here, the idea is that, let's see, this little pup is trading right now at 172.94. It's hard to predict. All right, so we look at a good out of the money option. They're still actually pretty pricey. The 173s, this is exactly at the money right now. We're trading all premium, $1.25. That's much more than we typically pay for these things. But the idea is that if and when the diamonds come down to, let me see if I can get this thing to display. If the diamonds come down to 172.36, I'm looking for some sort of bounce, so that if we're buying let's say the 173 call options, let's say they're trading at the time for, all right, they've got a delta value of about 50, so so they would be maybe 30 cents cheaper. All right, so let's say these things are trading for about 90 cents. So when the diamonds come down to that red line, the target, we buy 4 of these things for, let's say, 92 cents. And because we're expecting this thing, the diamonds, to turn higher from that number, as soon as we buy these things, we've bought the low, we've got them for 92 cents. And the idea is that we want to sell a higher strike, the 174, for as much as we paid for the 173s. So if we do that, we've locked in a $1 vertical spread, the diamond January 30th 173 174 vertical call spread for nothing. It costs us nothing. And those of you who've been with Rick Picks for a while know that, to me, is the fair value of an at or near the money option, 0. And if you pay more than 0 for it, you've overpaid. And over time, I'm going to guarantee you'll never make money trading options. So we basically need to get all our options for free. And the way we do that is to leg into these vertical spreads. We've done it in a bigger way in TLT, an exchange traded fund that tracks long-term bonds. In that case, we were looking to do the buy side, but we were not going to do this, sell anything against it, to short options of a higher strike against it for a few days. But you only need a very small move to get to buy these 173s, let's say, for 92 cents. And you might get a rally of 20 or 30 cents in the underlying diamonds. That's all it would take to allow you to sell a 174 strike call for the same 92 cents that you paid for the 173s. So it's putting on these vertical spreads that have no risk is it's something we can do as day traders. We can do it just in a scalping kind of way. All right, so that's the kind of long and short of it here for playing the 172.36 target. And depending on the pattern, this one has unusual, it's got very good clarity to it. So I'm almost certain that we'll see some sort of tradable bounce from 172.36. And if that's the case, and we bought some of those January 30th expiration 173 calls, we might be able to short some 174s against them within 5 or 10 minutes for the same 92 cents we paid. And another nice thing about these options trades where we leg into riskless spreads is that even if we're wrong, we can usually make a few bucks on it. We're not going to be so wrong that we're buying down there and it just keeps plummeting. We're going to get some sort of upturn from a midpoint pivot that's this clear, and to the extent that you get any upturn at all, it gives you the ability to take at least a small partial profit on the position that would at worst leave you with a break-even stop loss on whatever part of the position remains. Let's see, Mangas wants to look at GDXJ, so let's take a look. This is a very popular trading vehicle, and I'm going to pause for just a second here. Let me see if I can get this screen to display better. All right, I just closed a couple things up, and well, it didn't fix the problem. So, and I repeat, all the Citrix best and brightest can't figure out how to resolve the problem. It has to do mainly with the fact that their antiquated platform is not programmed. It's not coded to take advantage of multiple core processors. So that's the problem. All right, so GDXJ, I want to look at something. I want to look at more than we're seeing on this 15-minute chart just to get the lay of the land. And you can see that the big picture is unambiguously bullish. Let me see if I can get rid of some of these lines here. All right, so even after the nasty move down of last week, we still have a nice bullish pattern that comes from this low here, A, B, C, and it's a positive sign that the rally so far has managed to penetrate the midpoint resistance there, the red line at 28.95. So it looks like it's trying to turn that midpoint pivot into support, but the support as yet is a little bit shaky. So, but you can see the bigger picture looks pretty good here for GDXJ, which tracks a basket of junior mining exploration stocks. And at this point, we have a presumed target of 31.05, but it looks pretty good to me. As far as how you would trade it, we're in a just very minor bearish mode here over the last 10 minutes or so. This thing is groping for traction, and there are a bunch of ways to get in. I'm not going to go into them right now. If you're curious about how, then take the webinar in mid-February. There is a whole section on different tactics we use to initiate a trade. So anyway, GDXJ looks fine. If we back up a little bit, look at the big picture. Well, let me get rid of some of this. All right, looking at the big picture, we have reason to think that a speculative bottom might be in. Certainly, we would have looked for a turn from around 20.81. It's the very clear D target of this downtrending A, B, C, D pattern. So it banged on it a couple times, and now we're a couple months into a rally from that low. The actual low was about 50-some cents above the purple line. That's it's not as close as I would have expected, but it's close enough for us to think that that this rally is the real deal. So far, as you can see, the rally has gotten past one prior peak right here, and that's a good sign. It would be an even better sign if we got past a second peak up there at the number is, let's see, 39.62. So that would be quite a rally, but again, the payoff is that you'd be seeing the weekly chart turn impulsively bullish. That's something that hasn't happened in a while. It did happen actually last summer. We had this nice rally, very promising rally there, got past one internal peak and some externals here. And instead of the pullback and another leg up that we might have expected, it just kept coming down, down, down till it finally took out that low right there and transformed the weekly chart into something that was impulsively bearish. From that point, we had kind of a duel going on, bullish sign here, bearish sign there, bullish sign there. So the weekly chart is in what I like to refer to as dueling mode. And the duel settled in favor of the bad guys. GDXJ came down to make a final bottom at a D target that was near a D target that was certainly very foreseeable. And actually, I'm not sure I've got the right D target. You need to make sure that you pick up the right. Well, it turns out we've got one a little bit lower. All right, so anyway, we got a bounce from about where we expected, and so far the bounce is moderately promising, but we'd need quite a bit more before we could break out the bubbly. The daily chart is something, again, it's interesting because we have a good impulse leg. It's a bit subtle. The strength of it is disguised, but this little rally from here to there got past one internal but also an external peak, so it's a good legit impulse leg. And when we get a pullback almost to what we're using as our point A low of the pattern, I love getting in. I love doing the entry in a mechanical way. The actual buy signal on this thing came at 27.89, and it is a positive sign that GDXJ has traded above the midpoint resistance there, above the red line. So there are a lot of things to like here. It was a very, very solid buy there at 27.89. You'd have $1 profit in the position now, and it still shows promise, again, with an immediate target of 31.05. Rick Thomas wants to look at a stock that I haven't looked at in ages, Goldcorp, and it is just as bullish as that chart we just looked at in GDXJ. Just to put some, to flesh it out a little bit, the entry signal for a long position actually tripped today at 24.09. Jury's still out though. We want to see this thing get not only up to the red line, the midpoint pivot, we want to see it go through that red line and do so decisively the first time it touches it. So to the extent that the red line puts up no discernible resistance, that will be a very good indication that the rally in Goldcorp will continue all the way up to 27.91. If you made entry at 24.09 on a percentage basis, that is 16% or so. Pretty good rally. So or let's see, about 16%. So Goldcorp looks pretty good. It looks as good as it's looked in a while, and it just keeps kind of doing what it should. The first impulse legs that we saw, or the first one we saw, was right here, A, B, got past internal, and slightly past that external right there. So this was a nice setup. You had a beautiful buying opportunity down there in the low $20 and change. And if you missed that one, we're really repeating that structure right here with a new buy signal tripped as of today at 24.09. Typically, we don't do these entries mechanically in that way, getting long at 24.09 with the stop loss just below 22.82. That is effectively a stop loss of $1.21. Risking $1.21, typically we can find ways in that don't risk more than 4 to 7 cents. So $1.21 is out of the question, but there were other ways to get on board today. We don't do it With the daily chart, typically we would come down to a chart of very lesser degree and use a correspondingly smaller pattern to make entry. One of them would be right here. And so instead of $1.21 entry risk, we've got something closer to 12 cents of entry risk on a long position initiated somewhere around here for reasons that are proprietary. I'm not going to go into them. But you also know that at any point along the way of this, at this point, we've got a meandering pattern sideways. There's always a way in. And to the extent that we use teeny tiny little ABC patterns to make entry, we can cut our risk down to size. Emily wants to take a look at Goldman Sachs, one of my favorite bunch of sleazeballs. All right, we want to see something bigger than the 1 minute chart here. Let's see what Goldman has, all the bank stocks have certainly come well off their highs. It turns out that even Goldman's sleazy trading desk that probably front runs its own Goldman customers about 90% of the time, even they're having trouble stealing. So it's reflected, of course, in the fall of the stock from close to 200 down to recent low of 170. Let's call it 173. All right, so there is some damage here. The last time we impulsed beneath the prior external low gives us this impulse leg here. Looks to me like the stock will come down to 174.70. The pattern I'm using to project that midpoint hidden pivot support is not exactly a beauty contest winner. So I wouldn't depend on the red line to provide support very precisely, although it's possible that it will, and it's certainly a place where you could go bottom fishing with relatively little risk. If the stock simply tears through the red line, then it would suggest that it's got eyes for the sibling hidden pivot down there at 166.42. Look at the stock. We have I don't get requests for IMAX too often, but it looks like it's having a pretty good day. I don't know what the news is with IMAX, maybe some deal in the movie world, but to project a target, I would use this one off A down there, go up there for B, and it looks to me like the stock will achieve a minimum 34.63, but I'd be careful up there because the target is clear enough that we should expect some sort of pullback at the very least from that purple line. So if it goes through 34.63, you've got a little leeway to project a slightly higher target, 35.07, but somewhere in between those two numbers, either 34.63, 35.07, or perhaps something in between, you're going to get a short-term top in this stock, and I'm going to guarantee you that one. John says, new guy here, first webinar, not sure if you prefer to get random symbols. Answer, can you show VIPS? Let's take a look at whatever that is. VIPS. Very clear pattern. I mean, it couldn't get much clearer than this, so let's just sort of run it like this. And we see relatively precise resistance at the red line at the midpoint pivot. The first time it hit it, you can see that it failed. It came all the way back down to the green line, and it head-butted it again, pulled back for a day, and then it's only this, Friday and Monday and today that this thing appears to have broken decisively above the midpoint resistance. So what it's saying is that there's a very likely, a strong likelihood of a move to the 26.66 target. And of course, we can use um, impulse legs of minor degree to fashion ourselves relatively riskless entry points. Here, the implied entry risk, if we're in at the green line with the stop loss just below this black line, 1881, then the implied risk is $1.96 or so. And we don't need that. We want to get in risking 4 to 7 cents per 100 shares, not $1.90 or whatever it was. All right, so one of the ways we do that is to focus on smaller impulse legs, and we've got one right here. We've got a little point A low there, and so far tentatively a B high, but it's not in yet. But that's a good little impulse leg, and any pullback and follow through rally would be definitely something to jump on. But it looks pretty good, and just before I leave this, let's get that target one more time. Looks like 26.66 to me. And you've got the May 20 calls, you say, and I'm not going to guarantee you that you'll lose money on them, but one point that I've repeated, I'm guessing 5,000 times to my subscribers over the years, is that nobody ever made money playing options as directional bets. In other words, buying calls just because you're really bullish on a stock, or buying puts if you're really bearish. In 40 years, I don't know anybody. I've known thousands of options traders, but nobody's made money with that strategy ever. So reason being, if you're buying those May options, it's not like the guys who sell them to you are unaware of the possibility that this thing, that the stock could rally to whatever. The options are handicapping vehicles. The options scientifically and intuitively and in all possible ways discount the same move that you're looking for. So the options are priced in such a way that if the stock gets to where you think it's going to get to, that you won't make anything on a trade. It's sellers of options who make money. We're exceptions to that because with every options trade that we do, I take 40 years of my own experience and I put it into that trade. And trust me, it takes everything that I've learned in 40 years just to have a moderately positive expectation on a trade. But and another thing, as far as going out to May, the idea there is, well, I just want to give myself longer to be right. When you give yourself longer to be right by buying options, you're absolutely destroying your chances of winning because time works against you when you're a premium holder, when you buy puts or calls. Time works against you. So again, the rule of thumb there is that you shouldn't buy any options unless you think they're going to be in the black within 60 to 90 seconds of when you bought them. So that's a good rule of thumb. Instead of going out to May, you should go out like to the January 30th expiration. Even that's a lot, really, because that's still 3 days off. But typically, you don't want to go out more than a few days on these things. There are other types of positions and strategies we do that allow us to go out to May. The idea being we buy a May, and then the thing rallies, and we short the same strike of options that expire closer in options, and we simply roll the calendar spread from 1 week or month to the next. All right, let's see. We've got a question from Hakeem. What are your levels for the E-mini S&P today? Let's take a look, because I haven't really looked too hard. I was just sort of feeling nice, refreshed by the fact that this thing was getting its butt kicked today. It's always a pleasure, a joy to see the market seemingly responding to reality, like acting like it exists in the real world. All right, so, and you can see we're down a ton today, but it doesn't look like too much on the daily chart. I mean, a whole, 300 plus decline is like nothing on this. Let's see, we were at a high 2054 and we've come down as low as 2013. So it's 40 points over 300 Dow points. And yet, on this daily chart, it doesn't look like anything. The key to me of this chart, the analytical key, is, let's see, 206250, 2062. All right, the key to the whole chart, and if you have any Elliott wave experience, you'll see it the same way, is that this high exceeded that one by 2 ticks. So one point of agreement we have with a very significant point of agreement that we have with the Elliott wave guys is that this whole rally from here to there is not merely corrective relative to the downtrend begun up there, it's impulsive. We've got a high there that exceeded that peak by 2 ticks. What that implies is that anything, even a move all the way down here, the Dow is down 700 or 800 points, that down move is still corrective relative to what we're calling an impulse leg, a rally from here to there. And the whole thing works simply because this high is slightly higher than that. And a lot of technicians don't read it that way. They see this as kind of a double top with that, but we're not kind of people. We don't analyze things that way. We are pretty much in the same camp as the Elliott wave guys, and we darn well know the difference between an impulsive move and a corrective one, and this rally is impulsive. So it means that this nasty little sell-off that we're getting today, based on something as absolutely trivial as totally irrelevant to the market as the earnings of large companies, it's just a lot of bull. It's a shakeout. So I wouldn't worry too much about this pullback being the beginning of some, mega bear market. It's not. It's a little shakedown so that the scumballs who run this little dog and pony show can accumulate things at fire sale prices. So as long as they've got all these bad earnings reports coming in, then what better chance to kick the crap out of the stock, the market than today. So we're in the here and now, and this is just a sleazy little shakedown that we're seeing today. All right, so as far as trading this little puppy, on a big chart, there's not much here. I mean, we tend to want to look for trades on charts of lesser degree when they are indicated on charts of larger degree. But in terms of larger degree, we're in the middle of nowhere right now at this moment. So let's go down to the hourly and see if there's something we can get a grip on. I'm going to start here, but I'm going to have to move my... All right. All right, so we don't get anything especially meaningful here other than the fact that the whole move down is impulsively bearish on the hourly chart, mainly because we've got this down, down, down leg that actually took out some prior lows. This one here, what we call an internal low, and that one there, an external, and also a minor external right there. So this is a pretty powerful bearish impulse leg on the hourly chart. And we'll get a sense of how much power may be left when we see this thing correct, because, well, I'm going to give away, not the store, but I am going to give away a little proprietary trick. Good, strong bull markets generate A, B, C corrections that do not reach their D targets, but which reverse from the midpoint pivot. So we're going to need to see this thing go up, up, up a ways and then fall. And in falling, when we see how this thing interacts with the midpoint pivot, it'll give us a really good handle on how much selling may remain. So, and we can do this, we can go down to right now to a chart of 1 minute degree and get those vibes without having to wait for the rally and then the looping over for a presumptive second leg down, because all of our indications of strength or weakness are in charts of the smallest degree. Whatever is indicated, whatever is happening in the hourly chart, if we were to go down to the 1 minute chart, we would find the same indicators, the same things going on. In this case, what's going on of analytical significance? Well, we've got this ABC rally that exceeded, well, no, it hasn't actually. Eyeballing it, it looked like it got past the D target, but a sign of incipient strength, the sign that this thing may be, the worst of the selling may be behind us, would come in two ways. It would come in ABC rallies that exceed their D targets, which this one hasn't quite done, and or in the form of ABC corrections that do not reach their D targets. And in that regard, we've got right here a downtrending A, B, C. And you can see, even though it tripped the short right there, it didn't even get to the P midpoint. And that was telling us buy to get long, to buy the first tradable move that you saw going in the opposite direction. Notwithstanding the fact that the little dirt ball stopped out longs twice. Here, if we're A, B, C, we get long there, stopped out there. Another lower low there would have stopped out anybody getting in up here. So it was a little tricky, but the strength of the rally, the fact that the rally would at least reach its D target, was telegraphed by the ABC weakness of this downtrending pattern. Bonk, bonk, bonk. All right, so we could have gotten short. This looked like a promising short at 2028. We might have missed the trade because this thing missed our target by a single tick. And when we get a lot of clarity in a pattern, typically we don't put our short offer up there at 2028 because we quote unquote know that if it tops there, exactly there, we may not get filled. So we would have had our short out at 2027.75 and maybe or maybe not gotten filled. And you'll know that I love to take a small profit on just the faintest move going our way. The idea is that when you've taken a little bit of the house's money off the table, it just enhances your decision-making karma. If you've, I asked this question in the webinar, but I'll ask it here. How many have been in a trade where things just kind of went against you, and you got a little bit nervous, and they went against you a little bit more, a little worse, and you got even more nervous, and finally it really goes against you, and you think, oh geez, I'm bailing out right here, and of course you pick a place to bail out, to jump out of the trade that is, if you had a crystal ball, you couldn't have timed it worse. You think, I can't believe it, I got out on the exact low. If I'd held this thing for just another 10 seconds, I'd be rich. I know that anybody who's traded has been in that place. Second question, how many of you have been in a trade and it went your way and you thought, I like this, and just kind of working, I think I'll take a partial profit here, and you took the partial profit, and sure enough, you got a little bit of a pullback from there. You took some money off the table at just the right time. Then it goes a little higher, and you think, oh, this would be a good place to take another profit. And it's like you got the range and the rhythm. Things are just working right. How many have been in that situation? All right, so I can see we've had a few traders that have been right there. Well, there's a way to make that happen. There's a way to get in that psychological space where you're just doing the right thing. And to me, the easiest way to do that is to take at least a small partial profit early in the trade, because once you've done that, it'll be like a stair dancing with Rogers. You'll just have the range and the rhythm, and things are going to work out. So the best way to put yourself psychologically in that good space where the decision making process is untroubled is to just take a little of the house's money out of the trade early on. It doesn't have to be a large sum. All right, so So we know that when we get a good clear target like that 2028 that took an hour or so to reach, that it should hold for 10 or 15 minutes. And if this thing is banging up against it after just 5 minutes, then it tells us that the bulls aren't quite done. There's more buying power here. Although, at this point in the rally, we need to be very, very careful about how we get on board, simply because we've got a lot of company up here. Everybody is pretty bullish. We've got a rally that has gone on for 2 hours now. So, the bullish idea has kind of insinuated itself on the mindless herd, and we have to consider that ourselves. If we're going to get in there, we don't want to get in with the comfort zone. We want to get in a place where something has happened that would at least make a few of those bulls give up on it, to think, oh, well, maybe I'm wrong. So I wouldn't mind a little pullback all the way back down to here, and a little rally. Everybody thinks it's rolling over to make it another leg down. That is the rally that I want to jump on. But up here, a little bit dangerous. All right, so that's about as much as I want to say about the E-mini S&Ps. Farid wants to look at Apple, so let's take a look. I like Apple. It's, if Apple isn't going to be moving higher, then the bull market's over. This is the bellwether. It's the biggest stock in the world by valuation, and it's a good story. There was somebody out there, who was it? I think it was Henry Blodgett, with reasons to sell Apple, but I think he's full of crap, as he always was. Although he's not a lying full of crap guy anymore. I guess he must have signed some form with the network that said he wouldn't be a liar, and he wouldn't send messages to his cohorts that would offend the sensibility of retail buyers. All right. Anyway, enough of Henry Blodgett. All right. So I like Apple, and I've been using a 129 target forever. The consolidation, the presumptive consolidation that Apple has been in for a while, it's taken its good old time. But to put it in perspective, the earnings cycle based on hardware sales alone is enough to carry the stock for another year. But you've got still more kicking in on the speculative side, with the idea that Apple is going to take a small piece out of virtually every transaction, every small transaction with Apple Pay, and I wouldn't put it past them. I don't like Apple in the ethical way. I'm a little bit distrustful of what they might do if they had a monopoly with Apple Pay on small transactions. And my skepticism comes from iTunes. I've got iTunes. I'm not a Mac guy, and nobody who's in the stock market world is a Mac person, because Mac isn't active there. But so I've got some PCs, and I've got iTunes on a laptop, and just every once in a while, and the MP files that I have my music on are from the Napster days. So I got them from nowhere as far as iTunes is concerned. They were just mine. I owned them. I put them into iTunes, and so periodically, and I suspect it's probably after I succumbed to one of those updates. Apple is constantly wanting you to update iTunes, so I open iTunes, and I'll click on a track I wanted to play, some Charlie Parker tune, and it'll say file not found. And here's the funny thing. You go into the Apple store and you talk to their quote unquote genius bar, and those, I don't know whether they're just lying whether they're told to lie, or whether they're just too stupid to know anything other than a little bit of Apple. But you come in there with your PC, your Windows-based laptop, and say, what happened to 2,300 music MP files? And you know what they say? They say, I don't know. It's like the first time they've ever heard that problem before. But it subsequently was exposed as going right back to something that Jobs said. You know, when Jobs was first shown the iTunes or the iPod, um, the engineer mentioned to him, he said, well, you know, this will play pretty much anything from any device. And Jobs' response was, we'll have to change that. So the whole exclusivity thing, the closed platform thing with Apple has always been, well, it's been a strength and a weakness for a lot of years. It was almost the cause of their death. But I don't trust Apple. You know, I don't trust any company that makes your whole makes 2400 MP files disappear, and then you know they act like they don't even know why that happened or how that happened. All right, so a little bit of an aside on Apple. All right, so everything in the world says this thing's going to 129.20, but obviously if you had bought call options when the actual move to that target was signaled back in, well, January 8th is where we first got notice. All right, so if you're, you know, I'm pretty bullish on the stock, but I certainly wouldn't be in there buying call options. You could do it in the way that I just explained, looking to buy some option, let's say down here by the February something or other 115 strike, and on a little rally, you can sell a 116 or 17 or maybe even a 120 strike for the same price you paid for the 115. So that's how I would play Apple using options. And we'd have to go out far enough into February or maybe even early March that the option on the long side of our trade will be in the money before it expires. All right, so you know, we can't chisel this stuff in stone, and I would like to see this stock get above the red line, above the midpoint pivot, before I really effuse over it. But you know, I don't see any real trouble here. The only negative I could find is that this high from yesterday just chickened out. It stopped just shy of surpassing that external peak there. If it had done so, there'd be no question, you know, Apple would be a screaming buy on this pullback today. But the market as a whole wasn't particularly strong yesterday. And, you know, Apple can only buck the tide to some extent. Mr. Goatherder wants to look at a stock called SLCA, a fracking company which seems to be having its troubles. I mean, I guess, you know, its troubles have tracked the decline in crude oil prices, but just to give you minimum downside on this little puppy. All right, so this is, you can see where this thing is kissed very precisely. It's kissed the midpoint support there several times, and I never claimed to have a crystal ball. You know, for all I know, these bounces off the midpoint pivot could be the real deal, and SLCA is never going to go any lower than it is today. Like right here began a rally that will continue for the next 10 years. We don't know. I don't try to pretend that I have a crystal ball. What we do know, though, is that if this thing cracks that red line, it's going exactly, give or take 2 pennies, to 13.21. And of course, on a percentage basis, that would be hellacious. Let's see, 970. Let's see, 9.7 divided by 22. All right, that'd be a 44% decline beneath the red line. So all I can say is you better cross your fingers and hope this thing holds the line, because it's unambiguous as to what's going to occur if that red line gets taken out. All right, I think we've, it looks like we've run out of questions here. Let me see if I left anything. Nick asks about FXCM. Some of your chat room members made good money. All right, let's see what that is. FXCM. And I have no clue what this company is. I do have a clue that it's something you want to stay the hell away from. Now, there's not much you can do with this. I mean, I don't know. What's this company do for a living? FXCM Inc. Whatever they do, they were perceived as doing it much less well than in the recent past. I mean, the stock was 18 bucks not long ago, and here it was last week trading $1.28. I don't know. This you can't. I don't. Not that you can't nail any stock. I mean, we can get on a 1 minute chart and find ways to get long this little piggy. Like here, A, B, C. You're long from 45 minutes ago, and either stopped out with a small profit there, or who knows what you are. But the next trade I would take in this to get long would come from this pattern right here, A, B, and I'd love to see C down, down just a tick or two above this point A, so that when it starts up, that's a definite. That's a definite. Notwithstanding the fact that it doesn't look so good. I mean, it looks like, I don't know. I don't know what this crazed animal is, but Francis asked me if there anything to say about Ford Motors. Very clear pattern here. Well, it was clear until TradeStation absconded with it. Let's see. All right, this is a real. It's in dueling mode, so it's it looks to me like it's just in a hunkering down mode. It could go sideways between 14 and 16 for the next month or two, but that's what I'm getting from what I call dueling impulse legs. Bearish impulse leg here, answered by bullish impulse leg there. A slight bias, I guess, bullish, meaning recovery for this stock. But, the worst case would have to come from this pattern right here. A, B, C, and let me get TradeStation to give me a genuine A, the one that I want up there. All right, so big, well, let's see. Big picture has this thing going down to at least 1382. Hasn't been down there yet, and it's not written in blood that it will get there. But worst case for Ford would be, let's see, $11.51. But you don't get a sense that it's going to go that way simply because the CD leg is becoming so elongated. That elongation implying it's just reluctant to go lower. So, but it doesn't look like too much is going to be going on here. Netflix is ignoring the markets. Let's take a look. I have mixed feelings about Netflix. That's pretty stupid. Ignoring the markets, to say the least. Let's take a look at the weekly chart. I mean, I don't know. Even Steve Gilburn says that Netflix is one of the best run companies out there, and I am never eager to contradict Steve Gilburn. I did mention this in the chat room, by the way, but if you have an investor's interest in something claimed to be a cure for type 1 diabetes, just give me, email me at rick@rickackerman.com, and I can put you in touch with Steve. You can actually find an interview that he did concerning his diabetes cure online. It's a regimen of exercise, mineral supplements, and diet, but the exercise part of it is intended to generate electrophysical activity in the body to rejuvenate pancreatic islet cells. So if Steve hadn't impressed me so much as a trader, I'd think, oh, what a lot of bull. But he says that he has achieved complete recovery for something like a dozen type 1 diabetes patients in Boulder. And he also says that he's got $30 million escrowed for a trial. His plan is much bigger than that, though. He's essentially looking at something that would allow clinical tracking of glucose levels in thousands of patients in real time. And he's got a quite savvy web person to essentially put that into the cloud. So anyway, if you have an interest in an investment that ties to a purported cure in diabetes, just drop me a line. All right, so Netflix, which how did I get on that? Steve Gilburn likes Netflix. It's really bouncing around. This stock has had some wicked swings here. Just in the course of a consolidation, we're seeing 300 to 500 and back again. So I don't know. There's no real question about the direction of the move. I mean, it just says higher. And I don't remember seeing any patterns like this one that produced, a collapse. I know some people see a Head and Shoulders here, but I never see the Head and Shoulders are everywhere you want to look for them. I'm not a big believer in Head and Shoulders patterns because they don't work about 97% of the time. Well, in a bull market, I would say that's a little bit understated. They don't work about 99% of the time. It's like the Hindenburg omen. One other thing I'm going to put out to you, my friend Peter Eliades has a really interesting report out, his latest newsletter. And Peter, for my money, is the best cycles guy out there. And he's looking at, I believe it was a 233-month cycle that has remarkable properties. But bottom line is that they give rise to speculation that we would have a major top sometime in 2015 in the window May till August. I'm going to see if I can work something out with Peter to put that latest report in your hands, maybe on some sort of a trial basis. So watch for that. I'll put a link in the chat room if I can work out some sort of deal with Peter, or even if I can. I think that he routinely offers some sort of at least one free issue to trial subscribers, but he's a great timer, great cycles guy, and I guess you could say he's been fooled because we're in a market right now that has essentially broken the bonds of so many longer term cycles that you're left with relatively little that's predictively useful. But Peter was Holbert's top timer of the year for 5 straight years. He's not a fraud like Don Wallenchuk. Peter is the real deal. Eliades, his last name is Eliades, and I think the actual website is stockmarketcycles.com. And I shouldn't be so hard on Don Wallenchuk. He's just really, as a human being, he's pretty obnoxious. And the secret of his, he makes claims about being a great timer himself, but always been essentially has been bullish forever, and it's just kind of worked out for him. And what about Armstrong? Armstrong, I think, is almost universally respected. I mean, he's, as a cycles guy, he's a very patient sort, and whereas a lot of us perma bears, Chicken Little doomsday sky is falling types or won't to see the sky is falling like tomorrow, Armstrong generally has a perspective that's much longer term. Like he can be very bearish, but he'll also say, but yeah, it's not really going to play out that way for another 3 or 4 years or whatever. So he's got a lot of patience. We've got a comment here that Armstrong has called for a panic cycle tomorrow in gold. Not sure how cycle relates to a particular day, but I'm assuming you mean that that there'll be a buying panic in gold beginning tomorrow. And I have to say that's one thing that's it just feels right to me that even though gold can get hit on a day, if someone were to say to you gold is going to do something spectacular in over the next week, you would almost automatically assume that it's going to be spectacularly bullish. There's, even though there are things out there in the real world that undermine the bullish case for gold, nothing does so with the force of whatever story you might be able to contrive that has bullish implications for gold. So let's see. So you say the abrupt move or outside reversal. Well, we'll see. A note here that FXCM is a brokerage company, and they got oh, I see. So they were on the wrong side of the Swiss franc. Oh, too bad for them. Take a look at QQQ. I've got a request there. Very clear pattern to play with, just to get us started here. Always, you know, this feels like constipation here, or what's the condition is actually tenesmus is the right word, I think. But it just about got there, not quite, you know. And so I'm stuck with having to tell you that there's an outstanding target at 107.52, but I don't want to be caught with my pants around my ankles if this thing never quite gets to the target and drops down to 60. I mean, how would that look? But that's kind of where I am if I don't put anything instinctual into the way I read this this chart. And you know, at the instinctual level, I just don't see a top here. I mean, I see a thrust to new highs, and yeah, there's a question of whether we need, or we would need, a 3 or 4 month consolidation only to have this thing make a marginal new high at the target, you know, just barely above this last high that was made in Thanksgiving at 106.25. So the weekly chart, you know, gives us a big picture perspective. Not much to trade though. If we take her down one step at a time to see how we might trade this little animal, even with those vertical spreads that we try to leg into with puts or calls, we want to do it when the big chart is showing us something promising, showing us that a significant move is likely. And I don't think we're there right here. We're sort of in the middle of nowhere, in limbo land. This thing is trading, if you drew a line right through the action since October, we're at about the midpoint. So this is definitely a bad place to be buying options. I guess if it's so horrible for buying calls or puts, then perhaps it's we should be selling straddles here. So let's take a look just to see what we get for at the money straddles. All right, so we'll go out, well, let's see, a couple weeks on the straddle, and we'll 102. All right, so the 102 straddle is at about 260 for 8 or 9 days there. And if we come back to the chart sort of visualize a move of $2.60, in other words, something that would take us outside of the protective range of our straddle, you can see we don't want to lay that bet. You know, we don't want to be selling, even though I'm looking at this thing and thinking it's going nowhere. You know, to say that it's going to stay within the bounds of here and here over the next 9 days, it's not a great bet. Over time, you're always going to do better selling puts and calls than buying them, but over time, they're always going to be carrying a few bodies out of people who got essentially blown up by negative gammas, positions that make you shorter as something goes up or longer as it comes down. That's a negative gamma position, and it is the net result of something like selling straddles. So when you sell straddles, you just want this thing to sit there, and you know how it goes. I mean, it'll be trading right here when those options expire, but not before it made some wicked move higher or lower in the meantime that basically took out all of the straddle sellers. So still a trade. I mean, there's always going to be a trade that we can find if we go down to the 5-minute chart and look for something to do. Well, same pattern that we used to project a target in the Indus. All right, so it picked up support just slightly below the midpoint pivot, and I would say the pattern's clear enough that we shouldn't have overshot that red line by even a zillionth of a hair. So we did overshoot it by exactly 9 cents, and well, I don't know. That should be enough to get it down to the D target, but maybe not. It's actually closer to negating the pattern with a rally above what we're using as our point C high of that pattern. So from a trading standpoint, even on a 5-minute chart, I'm hard pressed to find something that looks worth our time. Well, we've been at it for an hour and 17 minutes. Good crowd in here today. There were as many over the time we've been in here. Something between 60 and 70 people were here, and more than half still here. So I thank you for your interest. Before we depart, I have one more request here. UVXY. Let's take a look at that one. Ultra VIX deal. Ultra volatility. You know these all these ultra, these 2x and 3x vehicles are designed to fleece rubes. All right, so the important thing here is that high exceeded that external peak there by a zillionth of an inch. So it puts everything that's occurred today in a perspective of a correction. Let's analyze this here. All right, so the way it looks to me, it stalled at the P midpoint, just a hair below it, as we might have expected. Actually, there's a slightly lower low there. All right, so this is the true pattern, and it had a choice: either keep going when it got to that red line all the way to 27.20, or not. And so far, it's or not. And I don't even want to look at the options on this to see how nutso they were based on the gap up opening, the stall at the P midpoint there. Well, I am going to stop the recording.